Howdy, Jacob here. Today we're looking at Exelixis in the biotech industry, 10.1 billion market cap, 8.9 billion enterprise value. A lot of net cash here. Fantastic revenue growth. It looks like it has slowed down since 2018, but is still, even since 2018, you're over double revenue. But there was some massive growth in 2015, 2016, 2017, 2018, and their gross margin is almost 100%, meaning that the cost of goods sold is almost nothing. It doesn't take anything to create the product. They just have to sell it, advertise it, and top line is pretty big. So even here in the 2017, 2018, 2019, it was as high as 35 to 51%, has dampened down to most recent year 9.3%. Even still, you're looking at some pretty solid return on invested capitals. Definitely when it had immense margin, but even recently, 7-8%, not too bad. So this would be a business that if you understand the biotech, you're going to have an advantage over me. And if you really are confident that they'd get back to some of these margins, which might not be possible. These might be, maybe a lot of their business was on royalties, and now they really have started to do some R&D, trying to figure out new drugs to invest in, because there's a time limit. There's an expiration to a lot of drugs, and so that could be a possibility. And I mean, this is insane. Their R&D is over 50% of their revenue, so they are using over half of their revenue to try to find new drugs, probably, and new things to invest in. And I mean, like I said, the cost of goods sold is essentially nothing, maybe less than 5% of revenue. Sales, general, and admin is maybe 30%. And then you're looking at a huge percentage, over 50%, to R&D. The balance sheet shows 732 million in short-term investments, 263 million in cash, with no short-term debt, no long-term debt, and just 190 million in capital leases. So their interest-bearing debt is essentially nothing. Their short-term and long-term debt is zero, and they have way more cash in than debt. Cash flow statement shows CapEx increasing, so they do have some capital expenditures. So what it takes to keep the business running is existent. I know some biotech firms it's essentially zero, but we do see here they have capital leases and they do have capital expenditures, but in relation to their free cash flow, it is very minor, very little amount. So from a safety standpoint in relation to the balance sheet and producing cash, it feels very safe to me. But almost all investments are the present value of free cash flow. So let's look at what we think the cash flow will produce in relation to the current market cap. So for this business, based on what I'm seeing here, I mean, let's see what they do. On an oncology company focusing on the discovery, development, and commercialization of new medicines for difficult to treat cancers. Okay. So, I mean, there's a lot of companies looking at this. I mean, seems like they've been doing a good job. And if you hit a home run with one of your drugs, you can get massive growth, which is what we're seeing here. Can they keep that going into the future? I'm not sure. My initial analyses, I'm just going to go 8% with the type of margins. And I guess what have they done with their free cash flow? I didn't look at that. So share repurchases, bought back a lot of shares, and we see a little bit of share reduction there, but not as much as what I would think based on this. And then outside of that, a lot of reinvestments. That's pretty much it. I mean, they just reinvest and recently bought back some shares, but over the last 10 years, almost all their money is going into not share purchases, reinvesting. So that's probably why they grew so much. No surprise there. For margins, I mean, it's kind of all over the place. Maybe we're saying we've hit a more flat road. Let's do 15 and 20%. Share purchases, they haven't really done that a lot historically, but let's say maybe 200 million. So that'd be 100 million to offset stock-based compensation. That'd be 1%. I'm comfortable with that. That would put about 50+% of capital allocation to reinvestment to get this type of return, to keep these type of margins. And I mean, maybe 18 is too low, but that's what I feel comfortable with right now. So again, I feel like I am being a bit conservative. I don't think there's anything wrong with that. Is in the biotech industry. That's not something that I feel like I'm an absolute expert in. If you understand this business, your initial analysis is close and you've done a deeper dive and you really understand it, you think they can get back to these 40, 50% margins, or you think they can grow well over double digits or not over double digits, but over 10% pretty consistently for the next 10, 15 years, this is easily going to grow into its valuation and well beyond it. And so for me right now, it's not obviously cheap. It's not something that I obviously want to do a deeper dive in, but it's a fantastic company. And everything that I'm seeing from a numbers perspective outside of valuation at this point looks pretty good to me. Hope you enjoyed this video and have a great rest of your day.